Most households don't collapse from one isolated event. They collapse from layered shocks. First, inflation rises. Then, in response, interest rates rise. Then, discretionary spending slows. And then, businesses cut hours, layoffs begin, and households' incomes falls. And suddenly, a structure that once looked stable becomes extremely fragile. In this video, we're going to stress test the entire household system. Not just one expense, one debt, or one budget category, but the entire structure. Because this is how economists, FP&A teams, banks, and corporations analyze risk. And now you can apply those same frameworks to your own household. Before we stress test the system, we first need a baseline structure. This household currently appears financially stable. Income exceeds expenses, net income is positive, debt payments are manageable. But now we want to test resilience because stable conditions do not reveal fragility, stress does. At first glance, the structure looks manageable, but now we begin applying layered economic stress. Suppose, for instance, inflation begins rising sharply. Groceries become more expensive, utilities increase, insurance costs rise, fuel prices increase, but importantly, income does not rise immediately. This is the first pressure point. Notice what happened. The financing structure did not change yet, but lifestyle costs increased significantly while income remained flat. This reduced household flexibility, and now the structure becomes more vulnerable to the next shock. Now central banks respond to inflation. Interest rates rise, and this creates financing pressure, particularly on variable rate debt, lines of credits, home equity lines of credits, and credit cards. Notice carefully the fixed mortgage interest remains stable, but variable financing costs rise. Notice what changed. The lifestyle structure stayed the same, but financing rigidity increased. This is financial leverage pressure, and this is why high interest rate environments become extremely dangerous for heavily leveraged households. Now the economy slows. Consumers reduce discretionary spending. In other words, they lower their variable costs to deal with the increase in financing pressure. Businesses begin cutting hours, layoffs begin, and now the final shock arrives. Income falls sharply. Now the structure breaks. Notice variable lifestyle costs adjusted downward somewhat, but fixed lifestyle costs remain rigid, and financing costs remain rigid. And now net income turns negative. This is combined fragility. Most households do not fail because groceries increased slightly or interest rates rose slightly. They fail because shocks compound. Inflation reduces flexibility, interest rates increase financing pressure, then job loss removes income. And suddenly, a structure that once appeared stable collapses. This is why financial resilience matters, not just income. At this point, you are no longer simply budgeting. You are performing household FP&A. You can now stress test structures, model layered shocks, identify fragility, analyze leverage, and forecast financial outcomes. This is exactly how corporations, banks, and financial analysts analyze risk exposure. And now you can apply those same systems to your own life. Over the last several videos, we built the contribution income statement, lifestyle leverage, financial leverage, combined leverage, and full household stress testing systems. And now you can begin asking, how fragile is my structure? How flexible is my lifestyle? What shocks could my household survive? and what changes would improve resilience. Because ultimately, financial freedom is not just higher income, it is structural resilience.